Hi students, this is Dr. H. Mohan Sundaram. Welcome back to my channel HMS Accounts and Finance Academy. In today's class, what you are going to see is the similarities and differences between the cash book and receipts and payments account. Let us see the similarities first. Both cash book and receipts and payments account follow the same principle, real account rule. Real account rule. What does real account say? Debit what comes in, credit what goes out. If money comes into the business or not-for-profit organization in the form of cash or through bank, should be recorded in the debit side. Irrespective of the period for which the money comes in, it must be recorded in the debit side. It may be, the inflow may be for the current year or previous year or previous years or subsequent or next year. We don't need to see whether it is for the current year or previous year or subsequent year. If money comes in, it must be recorded in the debit side. And irrespective of the nature of receipts, it may be the inflow of money may be capital receipt or revenue receipts. It must be recorded in the debit side of the receipts and payments account. What is capital receipt? Capital receipts are non-recurring in nature. What is non-recurring? It will not happen again and again in the organization, or very rarely it may happen, or the occurrence of the incident may be more than 12 months. For example, life membership fee. Fee once paid by the member will be for his or her own life. Until their life is over or the organization life is over, they will not make any more subscriptions, right? Instead of subscription, they are paying the life membership fee. Or sale of fixed asset. This will not happen on regular basis. This type of sale will not happen on regular basis. So, how does this arise? Either by increase in the value of liability, non-current liability. Capital receipts arise in the organization either by increase in the value of non-current liability or decrease in the value of fixed asset. That means sale of fixed asset. Opposite to revenue receipt is, capital receipt is revenue receipts. Opposite to capital receipts is revenue receipt. What is revenue receipt? Revenue receipts are recurring in nature. It will happen again and again, periodical in nature, or the life is less than 12 months. Example, subscriptions every year or periodically, monthly, quarterly, semi-annual or annual basis, each member of the organization will have to pay membership fee, subscription in the form of subscription. Sale of old newspaper, rent received. There are too many things. When I work out some problems, I will explain them. Opposite to this is, what does the real account say? Credit what goes out. Credit what goes out is followed to enter the transactions in the credit side of cash book or receipts and payments account. Outflow of money in the form of cash or through bank must be recorded in the credit side. Outflow of money in the form of cash or through bank must be recorded in the credit side of cash book or receipts and payments account. And the outflow may be for the current year, maybe of the current year, previous year or previous years, subsequent or next years, irrespective of the period, the money goes out of the organization, it must be recorded in the credit side. Similarly, the outflow may be of capital payments or revenue payments. We don't need to see whether it is of capital nature or revenue nature. Whether the payment is of capital nature or revenue nature, if the money goes out, it must be recorded. The capital payments, this is completely opposite to revenue, right? Capital payments are non-recurring in nature. Capital payments are non-recurring in nature. For example, purchase of fixed asset, repayment of loan. Purchase of fixed asset or repayment of loan. Capital payments arise when some fixed assets are purchased. Increase in the value of fixed asset. Capital payments arise when the organization purchases some fixed asset. Increase in the value of fixed asset arise the capital payments, or decrease in the value of non-current liability. Opposite to capital payments is revenue payments, which are recurring in nature. Revenue payments are recurring in nature. It will happen again and again, regularly, periodically, or the life is less than 12 months. Or the life of payment is less than 12 months. For example, salary, rent paid, electricity bill paid, periodical, right? Audit fees. So whatever is happening in the organization periodically will come under the category of revenue payments. And one more important thing is that whenever we are preparing cash book or receipts and payments account, it will start with opening cash balance and opening bank balance, and it will end up with closing cash balance and closing bank balance. I hope that you all would have understood. I had told you in my previous shorts video that assets account will always show debit balance, but there is an asset account which may rarely show credit balance. Let me explain it now with the perspective of cash book or receipts and payments account itself, not with the perspective of bank passbook. Cash available in the bank account. Cash available in the bank account is an asset for the organization. Asset of the organization, and it is called favorable balance. And it is called favorable balance, and it will always show debit balance. And the money available in the bank account, cash available in the bank account can be used to meet out expenses or to make cash payments. To meet out expenses or to make cash payments. When there is shortage of cash in the bank account, it will show unfavorable balance. Shortage of cash in the bank account will show unfavorable balance, which means payments are more than the receipts. Actually, the organization would have paid more than the receipts. And the shortage of cash in the bank account is called bank overdraft. Bank overdraft, and it is a liability of the organization. What is bank overdraft? Bank overdraft is the short-term credit facility extended by the bankers to the organizations which have opened current account with them. By verifying their financial capacity and other parameters, the bankers will fix upon the credit limit, and the organizations can avail the facility up to the limit extended by the banker to them. And I hope that when there is favorable balance in the bank account, it is an asset of the organization. When there is unfavorable balance in the same asset account, it is called bank overdraft, and it is a liability. I hope that you all would have understood clearly about the twist I had posted in my previous shorts video. Similarities are over. Let us see the differences between the cash book and receipts and payments account, right? Cash book is periodical in nature. Usually the organization prepares cash book on daily basis. Date column will be there. Date wise the cash book will be prepared, and it will be prepared, it may be prepared on daily basis or weekly basis or monthly basis. Usually business organizations prepare cash book on daily basis because there will be inflow and outflow of cash. There will be inflow and outflow of cash on routine basis. But non-business organizations or not-for-profit organizations prepare cash book or update the cash book whenever there is an inflow and outflow of cash, because the cash transactions will not be routine in nature there. Whereas in the receipts and payments account is the summary of cash book. Receipts and payments account is the summary of cash book. Here, whenever there is an inflow or outflow, they record according to the date. But here they need to consolidate, they need to summarize everything. What is the total salary paid? From here, from the cash book, we cannot understand what is the total salary paid. Date wise we can see. Whereas here, they will record everything in a separate place and total them. Right? What is the total salary paid during the year? Interest paid during the year? Rent paid during the year? Or subscription received during the year? Donations received during the year? They will record them everything and will be posting into the receipts and payments account according to the nature of receipt or payment. There are three types in the cash book. Single column cash book, double column cash book, or three column cash book. In single column cash book, there will be only one column. All the cash transactions only will be recorded in the single column cash book. Opening cash plus receipts minus payments equal to closing cash, right? And the next is double column cash book. There are two separate columns. For cash and bank transactions. It will start with opening cash and bank balance all the cash receipts and payments, all the bank receipts and payments are recorded in the respective columns. All the cash receipts and payments, bank receipts and payments are recorded in the respective columns. Finally, this account, if there is opening bank overdraft, it should be shown in the credit side of the cash book. It should be shown in the credit side of the cash book, because it is a liability. Liability will always show credit balance. Finally, this account needs to be closed if the total of debit column is more than the credit, then the balance will appear in the credit side and it must be called bank balance. Rarely the bank column of the cash book may show negative balance. Then it is called bank overdraft. It is a liability of the organization. This is what I explained earlier in this video. The third is 3-column cash book. One more column will add with this: discount column, cash column and the bank column. This will usually be followed by the business organizations, because they do manufacture or buy and sell goods and services. At the time of making payment, they will receive some discount, or at the time of receiving payment from the customers, they will allow discount to the customers, right? Here you have to understand one thing clearly. Discount column of the cash book follow the principle of nominal account. Rule. What does nominal account say? Debit all expenses and losses, credit all incomes and gains. Whereas the cash and bank column of the cash book follow the real account rule. Debit what comes in, credit what goes out. But the discount column of the cash book follow the rule nominal account. Debit all expenses and losses, credit all incomes and gains, right? This will not be used by not-for-profit organizations, because they do not manufacture or buy and sell goods and services. They merely render services to the public or to the specific group of population without any profit motive, right? In receipts and payments account, we use only one column to record both payment and receipts. Actually, it will start with opening cash and bank balance, and all the receipts are recorded in the debit side of the receipts and payments account, because these are already summarized, right? All the payments are recorded in the credit side of the receipts and payments account by using the real account rule. Debit what comes in, credit what goes out. If there is opening bank overdraft, then it must be shown in the credit side of the account, because it is a liability. Liability will always show credit balance. At the end, we have to close this account. If the total of debit side is more, then the balance must be called as bank balance. It will appear in the credit side of the receipts and payments account. If the total is more in the credit side, then the balance will appear in the debit side and it is called bank overdraft. It is a liability. Bank reconciliation statement, BRS, is possible only from the cash book with bank column. Because all the transactions are recorded here date-wise. So we can easily compare the bank column of the cash book with the bank passbook. So we can easily reconcile the account. Whereas here it is not possible. In receipts and payments account it is not possible, because all the transactions are already summarized. The final point is, the cash book is the input for preparing receipts and payments account. Only from the cash book we prepare receipts and payments account. Whereas there, receipts and payments account is the input for preparing final accounts. Receipts and payments account is the input for preparing final accounts for the not-for-profit organizations. This is what I am going to teach in the next class, right? How to prepare final accounts for not-for-profit organizations from receipts and payments account. If you like this video, kindly subscribe, share to your friends and relatives, and turn on the bell notification. Then only you will be notified. See you in the next class.